Okay, now let's continue with this one where we are talking about post-acquisition. Now, what you need to do is look at this date. This is at acquisition when we are buying this company. 10 Limited is buying 64,000 ordinary shares of Tom Limited. Okay, so the date is this one. Now, I want you to pay attention to this date here. It's after acquisition. The acquisition date is this one. When we bought this company was January 2009, but now we are dealing with a year, meaning our current year is this one, but it is after the first date, okay, at acquisition. So this trial balance here is at this date, right? So everything that you see here, all these figures that you see here, they relate to this date here, okay? Now, after that date, things have changed. By the time you are here, here's the trial balance of that time. Okay. Now, the first thing you do is you need to understand that they are saying to you here, give us the analysis of equity of Tom. You see, people must not confuse this thing. They are saying Tom. So of the two companies, Tom is this one, right? So we are analyzing only one company, which is Tom in number one, right? Now, the first thing is the analysis of equity. Let me just explain the analysis of equity so that you know what you are dealing with. This is what we call an analysis of equity. This. So this thing has got three dates. Date number one is this one. And then date number two is this one. And then date number three is this one. Right. Let's look at the first one, at acquisition. At acquisition, it's this part here. Right. This top one. So when you acquired these 64,000 shares, we are acquiring the net asset value. Remember, we said the net asset value is the equity, which is this. Okay, that is the equity when we acquire the company on this date. So what we then need to do is to apportion this as per the ratio of acquisition, because we know we paid 95,000. Now, let's deal with this. 64,000 out of 80, it's 80,000 shares is 80%. So we are talking about this part here. You can see one ordinary share gives you 80,000, meaning there's 80 shares at one rate. Okay. Now, so let's then deal with this. 80, you split it into 80 and 20. And then 40, you split it into 32 and 8. 20, you split it into 16 and 4, meaning the split in terms of 80-20, right? Now, after splitting this thing, you add, and then you get 112. Then you must go and check how much did you pay for this. We paid, I can even pick it from here, it's 95,000. Right, you can even check it, it's still the same amount. Right, so we paid 95,000 for something that is worth 112. So we've got a gain on bargain purchase of 17,000. Right, then we come to this side. You've got your 16, your 8, and your 4, they add up to 28. Now, let's go and check if there's a sentence that talks about the fair value of non-controlling. Right, I'm looking at this. There's nothing here that talks about fair value of non-controlling, which means use the figures as they are. So 28, 0, because there's nothing that we must adjust according to the question. Then it gives me 28. Right. Now, 0 plus the 17, which is a gain, it gives you a total of 17, which is a gain. Right. Now, after that, you get to add everything in that column, you get all these are your figures that you are getting. So you've dealt with date number 1 once you do that. So this date is done. Okay, once you do that. Now we then deal with date number 2. This thing says since acquisition to beginning of the reporting period. Now, let's get to this. So this is your current year, right? This is the current year. Now, if this is my current year, what is my beginning? This thing, this since acquisition to beginning of reporting period. Now, let me write it down here. 1/1/2011 is my beginning. And that is the same as 31/12/2010. These dates are the same. Both of them, they are defining date number 2, which is this one here. You get my point? So it's 1 January 2011, which is the current day, the beginning. It tells you here it's beginning of the reporting period. That is the same as last year closing, 31 December. It's the same. So date number 2 in this exercise, it's these two dates. It doesn't matter how you interpret it, you'll get the same answer. Now, what you must then do when you get to this date is that you must analyze your equity. You see, here we've got an equity of 80 by 31 December 2011, which when we acquired the company, when we bought it, it was 80. So from 80 when we bought it here to 80 here, there is no change. So you don't do anything with the share capital. There is no change. Then we come to this one. When you bought the company, you had asset replacement of 20. Now you still have 20. Still you don't do anything because there's no increase or change in the amount. There's no change. But now, here you've got 40,000 under retained earnings, but by now you've got 80. So there's a change here of 40,000, do you see? But now, let's then explain this thing such that people can understand. Let's look at the retained earnings from here to here to 18. The first thing is that when you bought their company at acquisition, there was 40,000, right? When you bought the company. But now the company is sitting at 80. Beginning of this is sitting at 80, right? Now, what you need to be careful of is this. I can tell you today, the share that involves you will be 40,000. Right, I'm talking about this 40. Let me maybe explain this thing in a different way. If you start I start a company today and it's operating and it has 10,000. I'm just giving an example. It's 10. I've got 10,000 now, and you say to me you want to buy my company, or you buy a certain amount of shares in my company. You cannot share on my 10,000. I was alone when I was earning the 10,000. You were not there. But then anything after the 10,000, you can then share. Let's say by beginning of the year, I've got 70,000. I've got 70,000 in retained earnings now. So me and you can only share on the 60,000 together. On the 60 together, we can share the 60 together, but not the 10. The 10 I was alone. Right. So that is the same logic here, where you say, I started with 40, but now I'm sitting with 80. It means the increase is 40,000. So I must have a share on the 40,000. Right. Now, this is what they're saying. They're saying, by now I've got 80,000. But I had 40 when you bought the company. So the increase is 40. And that 40 must go to the people that have got to do with this 80%, which is 10 limited. And the 20 goes to the guys who are called non-controlling. Now, guys, just for the word of advice, let's say in this exercise, let's take asset replacement. You see, asset replacement is 20 here. If asset replacement here, for an example, was 50, you see there's a difference now. I started at 20 when I was alone, but by now, when I'm sharing with you, we're sitting at 50, but we can only share 30,000 because the 20 belongs to me already. I was alone. And you came and we earned 30, so we might have to share on the 30, you see. So if that was the case, we're going to have here asset replacement, and we're going to have a 30,000 here. But here, when we do the 80%, right, okay, let's do the simple one. 20% of that is 6,000. Right. You can't put the 24 here. You don't put the 24 in this line here. You don't put 24 here. You don't do it. Right. You must create a column here, another column here called asset replacement, and you put the 24 in its own column, because if you put the 24 with underneath the retained earnings, we're saying the 24 is the retained earnings, or else it's not the retained earnings. It is asset replacement. Okay. Right. So I was just demonstrating this thing that you must analyze all the equity. You start here. You say no movement. Okay, nothing. You don't do anything. 20, no movement. Don't do anything. 40, there's a movement because now it's 80. You deal with the 40. Okay. Now, what is very important is that you look at the date. You see it's 1/1, which is the date already that I've explained here. Right, that it falls here. Right. All right. You only analyze equity, okay? Right. Then we come to the current year, which is date. We are done with this date because there's no other movement in equity. Right. We come to date number 3, which is the current reporting period. Now, what you do from here, which is the revenue, you see 250 minus 150 minus 60, I think it's 100 minus Lona is 40 minus 12, it should be 28. So your profit after tax is 28. And that 28, you split it into 80, 20. Right. 80, 20. Right. Now, what you must then observe is that you see like here 123 plus 40 is 163. 95 is 95. There's nothing in that column. In this column, there's only 32, which is up to here. There's 32. Here, you've got 28 plus 8. That gives you 36. Okay. Right. Here's current period. You've split that into 80, 20. So if you add that column, it gives you 191 here. 95 is still 95. Here, it gives us 54 now because we've added 22. Okay. Right. This one here is 41,600 because we've added 5.6. Okay. Now, this is what we call the analysis of equity of Tom. So by merely doing that, you would have answered this one, number 1. Okay. Then we come to the statement of comprehensive income. Right, number 2. So what you do in this one, it's still easy because you take the figures you see under P, so under the holding company plus the subsidiary. For an example, revenue, you say 500 plus 250. Right. You do the same under cost of sales. It's still easy, this one. and then you go on and write while you are doing that. Okay, then you get your text and it gives us that. Now what I want to explain to you is this, right? So this whole thing I've highlighted. So your profit is 42. Now the first thing that you must know is this. When we look at, you see this figure here that I've highlighted. This figure must always, when I'm marking, I will check this figure and say, oh, you put 5,600 here, then I will come here and say, what is the figure that is sitting in date number 3 under non-controlling? You see it's 5.6, so it must match this one. And obviously, at some point here, it's matching this one. Now, so what is it that you are saying? You are saying this profit of 42, the guys who are called non-controlling are going to take 5,600. The balance from the 42, which is this one, goes to the owners of the parent. Now, that's basically what we are explaining here. Okay. Now let's see if we are able to deal with this thing going forward. Right, what's the next thing? Statement of change in equity. Number 3. Okay, this is number 2. Right. So don't forget that this figure, when we're marking, we track it back to here. It must be this one in date number 3. Okay, it must be this one in date number 3. Right. Okay. Now, let's deal with the statement of change in equity. The statement of change in equity is this one. Now we start with the easy one. Share capital is always the share capital of the holding company. Always it must be that one, which is the share capital of this company here. Here it is. It's the holding company. That's the one that bought the other company. Always that's what you put there. And then let me explain also the easy one. You see, now I'm controlling this opening amount. It's opening amount this year, 1 January 2011, that's 36,000. If you check, I can take you to the analysis. This was the beginning. By the beginning of the current year, you see you add 8, then it gives you 36. By the beginning of this year, meaning by the beginning of date 3, which is the beginning of this year, you've got 36,000 in that thing there. You see, 36. So that is my opening for this year. Then you add the 5.6, that is for date 3, and then it gives you 41,600. Always this one here must agree with this one here. They must agree. But in short, it makes sense because you've got 28 acquisition. Then since beginning of this year, you accumulated 8 and it took you to 36. By the time you start the current year, you've got 36,000 plus 5.6 gives you 41. So it should make sense that this one here must always agree with this one here. It makes sense. It must agree with this one. Okay. Now, to then go on and deal with the next one, here, you are saying it is 30,000. You start by, this is how you deal with this thing. You say P, meaning the holding company. The holding company is 30. Number 1, the opening balance. Plus what this company is entitled to until date 2, meaning until here. Until what the company is entitled to until date. But now, be careful here. There's no asset replacement here. It's only retained earnings. So it's 0, what they're entitled to until date 2, because of this question, the way it's structured. So it's 30 plus 0, it's 30, the opening balance. Is there any movement in the asset replacement reserve this year? Meaning, if there was something here in date 3, is there anything in date 3? Nothing. So there is nothing that will come in here. Okay. Then your balance is 30. Okay. Now then, let's then define something here, which is this one. Right. How do you calculate this thing? You say, what is the opening retained earning at the beginning of that year, which is this one here. It's 8. Right. Plus, how much is 10, I mean the holding company, entitled to in terms of retained earnings until date 2 here? It's this amount. So 80 plus 32 will give us how much? 30, it's 112. Right. But always remember that you must add this one. Okay. 17,000, the gain. So let's check the calculation. It says 80 plus 32, which is this 32 here, plus 17, which is this gain. Here it is. Okay. So it gives us the 129. Right. And then you transfer this figure here. You see the figure I've highlighted from the income statement to here. These figures must always be the same. Okay. This one that you put here must always be the same as the one that you'll put here. Okay. Right, then that gives you your retained earnings of 165. Now be careful, don't learn the habit of changing figures now. And always put totals here. Always put totals here. Put them. These totals. Because these totals that you have here, they are here. All of them. Look at them here. Here they are in the balance sheet. Okay. All these totals that I'm talking about from the top here, all of them, they are here. Okay. All right. Then the PPE, you say this plus that one, and then this one plus that one. For now, to make the life easy for everyone. Now, there is something that I want us to check here, if possible. Now, if you check here, you've got a situation where they are saying here this figure is 36. Let's try and see if indeed it's 36, this one here. I just want to prove it. Let's do this. So if I look at this from here to here, let's check. 500,000 minus 180 minus 300,000 minus 6. It's 14,000, right? 14,000. Okay. Let's put 14,000 here so I can see if I'm adding these things the right way. Right. Plus, how much is 10 entitled to here and in this state here? Is entitled to 22,400. Right, let's see. Let's say 14 plus 22,400. It's 36. You see? I can prove that that's the correct amount. Okay. So I was trying to do that to show you that we can prove that amount in relation to that. Okay. Just watch this video. I'm also going to deal with intercompany in the next video. Thank you.